Hello, and welcome to this lecture on forward guidance. In this class, we will examine a new monetary policy tool, forward guidance. Forward guidance allows the Federal Reserve to communicate future monetary policy intentions. This is communication about tomorrow's action rather than actions taken today. This communication can be about future inflation or economic growth. It often includes how the Fed plans on adjusting interest rates in the future. The goal is to influence market expectations and reduce uncertainty. We will discuss several examples of forward guidance. We will understand why the Fed uses forward guidance and how it influences financial conditions. Let's get started. Forward guidance is an unconventional monetary policy tool. Unconventional because it goes beyond the traditional conduct of monetary policy. Traditional monetary policy operates on short-term interest rates. In practice, this means open market operations and discount window lending. Forward guidance is relatively new. It arrived in 2009 when the federal funds rate was close to zero. At this point, targeting short-term interest rates was no longer an option. To overcome this challenge, the Federal Open Market Committee, or FOMC, decided to communicate how it intended to adjust monetary policy in the future. The Fed tried to target long-term interest rates. Forward guidance is the official FOMC communication. It may take the form of press releases, speeches, testimony of officials in Congress, and so on. These are usually very carefully crafted statements to the public. The goal is to avoid confusion. Forward guidance signals monetary policy intentions to the public. These can be actions over the coming months or years. These actions can depend on how the economy is evolving. The goal might be to move longer-term interest rates. Forward guidance can also reduce uncertainty. Let's first look at an early example of how the Fed communicates. Since 1994, the FOMC has issued statements announcing decisions from the most recent monetary policy meeting. Before 2009, these statements were brief. Check out this statement from March 16, 2004. It consists of one sentence about the interest rate, one paragraph summarizing current economic conditions, and one paragraph of potential risks. The statement also indicates which FOMC members voted for an action and which members, if any, dissented from it. Finally, notice the absence of any indication about future monetary policy actions. Now let's play Fed Watcher and compare this statement to the previous statement from January 28, 2004. In the second paragraph, the description of the economy slightly changed. In January, the expansion was brisk, but in March, it was only an expansion at a solid pace. This indicates the growth rate, albeit still positive, has decreased. Similarly, the description of the labor market is less favorable. The last paragraph is the same except for the insertion of that. These changes in language are watched closely by the public. What have they learned from comparing these two statements? Over the span of 6 weeks, the Federal Reserve has changed its opinion about the state of the economy. While the January statement was quite upbeat, the March statement is less so. What does this mean for monetary policy? Probably that the Federal Reserve will not increase interest rates at the next meeting. This is true even so no clear statement about future monetary policy is included. Now, let's look at a more recent FOMC statement. Here we can see explicit forward guidance. Here's a statement from March 18, 2009. At this point, the federal funds rate was close to zero. What does the FOMC say? The committee will maintain the target range for the federal funds rate at 0 to 0.25% and anticipates that economic conditions are likely to warrant exceptionally low levels of the federal funds rate for an extended period. This is forward guidance. The statement signals that the federal funds rate will be kept at an exceptionally low level, meaning zero, for an extended period, so the time frame is not exactly clear. How should the public interpret this? Well, financial market analysts would probably expect the federal funds rate to remain at zero for at least 1 year and possibly much longer. Now consider this statement from December 12, 2012. At this point, the federal funds rate was still close to zero, but raising rates was a possibility. You will notice that this statement is much longer. The FOMC explains more about the economy. They refer to specific sectors such as household and business investments. But here the FOMC does something new. In paragraph 5, it states that the committee decided to keep the target range for the federal funds rate at 0 to 0.25% and currently anticipates that this exceptionally low range for the federal funds rate will be appropriate at least as long as the unemployment rate remains above 6.5%, inflation between 1 and 2 years ahead is projected to be no more than half a percentage point above the committee's 2% longer run goal, and longer term inflation expectations continue to be well anchored. This is quite a sentence, so let's unpack this. The FOMC says that the target federal funds rate will remain at zero as long as, first, unemployment is above 6.5%. Second, expected inflation in 1 or 2 years is not above 2.5%. And third, inflation expectations remain well anchored. This means that everyone still expects 2% inflation in the long run. In other words, the FOMC would keep the interest rate low under these precise conditions. This type of forward guidance gives planning certainty. It clarifies what extended period means. The FOMC also releases minutes from its rate-setting meetings. These are word-for-word discussions in the meeting. They arrive 3 weeks after each meeting. The minutes give further insights about the policy-related topics that were discussed, the views expressed by participants, risks and uncertainty about the outlook, and the reasons for the committee's decisions. Of course, financial market analysts comb through these minutes to gain insights about future monetary policy. Since 2007, the FOMC has also published its Summary of Economic Projections. This comes out 4 times each year. The projections provide FOMC participants assessments of future economic outcomes. This includes GDP, unemployment, inflation, and interest rates. These outcomes are considered over the medium and longer run. Each FOMC participant provides an assessment. This allows the public to see a range of forecasts. Let's have a look at the Summary of Economic Projections from March 17, 2021. At the time, the economy was reeling from the COVID-19 pandemic. Here's the chart for changes in real GDP. This is GDP growth accounting for inflation. You can see that the forecast for 2021 varies between 5 and 7.3%. The difference in the short-term forecasts reflect the uncertainty about the recovery. In the long run, the estimates of the participants are really close to each other, so there's little disagreement about the long run. Also, from the March 2021 Summary of Economic Projections, we have the so-called dot plots. This chart summarizes where the FOMC thinks the federal funds rate will go. Financial analysts pay close attention to this forward guidance. At that point in time, interest rates were close to zero. So the question was, how quickly would rates increase? In 2021, no participant expected an increase from zero. By 2022, 4 participants think that the economy will have recovered sufficiently to increase the federal funds rate at least once. By 2023, almost half of the participants see the federal funds rate increasing. In the longer run, participants expect the federal funds rate to be between 2 and 3%. Of course, these forecasts are subject to revisions. However, they provide valuable insights in the FOMC participant thinking. Forward guidance of this kind allows for more planning certainty for financial markets participants. Let's wrap up. In this lesson, we introduced the concept of forward guidance and discussed several examples. Forward guidance is a monetary policy tool. It allows the central bank to signal how it expects the economy and therefore its monetary policy to evolve. The public, especially financial market participants, pay close attention. Routine forward guidance emerged in 2009 when short-term interest rates were very low. At the same time, the Federal Reserve introduced forward guidance to put pressure on long-term interest rates.